Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks and passionate investor. My last video was about my DSR Pro rating. This video is about the Dividend Safety Score. At DSR, we have two different types of ratings, and I think that as a dividend investor in general, you should have two. So then again, similar to the DSR Pro rating video, this video is intended to my DSR members, so thank you for being there. But also I decided to publish those two videos on my YouTube channel to explain how I rate my stocks, but most importantly, the importance of having a rating for all your stocks. It helps making me decision very fast. It's making my decision very clear as well. And I just can move on quickly and buy stocks that will fit my investing strategy all the time. So the Dividend Safety Score is very similar from the DSR Pro rating in the sense that it's also rated from 1 to 5. Then again, you can decide to make your own and rate them from 1 to 10. I know that some financial website, they will give a scoring from 0 to 100%. On my side, I haven't used a magic mathematic formulas, and I'll tell you why. It's pretty simple. When you just use metrics, you kind of lose the understanding of those numbers, and they will tell you a story, but it's not a complete story. I've came across a lot of companies recently in 2020, 2021. Bell and Enbridge, for example, shows payout ratios over 100%. It's the case with Sylogist as well, 100%, over 100% payout ratio, and yet they all increased their dividend. In the case for Sylogist, it was kind of crazy because in 2020, they showed I think it was like a 300% payout ratio or something like that, and yet they increased their dividend twice, and total dividend increase that year was 25%. So how could this make any sense, right? So if you just run a formula, probably that your dividend safety score will be quite low. It will tell you, well, payout ratio are crazy, the cash payout ratio was crazy as well, and then you would have a rating that is very poor, probably announcing a dividend cut, or the dividend is unsustainable at best and with no dividend growth, and yet you are in front of a company that has no debt, that has increased its dividend for the past 9 years, and the past 5 years it was like close to double-digit dividend growth. All that combined together doesn't make any sense with the high payout ratio. So this is why you need humans, and this is why you need a combination of quantitative metrics and qualitative metrics at the same time. So my dividend safety score is quite simple to understand, 1 to 5. The 1 are dividend trash. Obviously, companies that have cut their dividend or are about to cut their dividend. So those companies, I don't want them in my portfolio. When the company has to cut its dividend, because it has failed its investor. My money is too precious for myself, for my retirement, for my family, that I'm not able to waste time and giving second or third chances to companies that are not able to manage their business well enough to preserve their cash flow and reward shareholders on time and pay their dues. For dividend safety score of 2, that has 2 categories. The first category is companies that we don't like in sense that they have not increased their dividend for a few years and their payout ratios are very high, and then you could definitely expect a dividend cut at one point, especially if we run into a recession or what we had last year in 2020. A lot of bad businesses has been riding the wave, the bull wave, for like 5-10 years, and everybody was like, oh, it's all good, the yield is high, but even though the dividend doesn't increase, they still pay. And then boom, you get a market crash, you get a recession, and then all those companies, all of a sudden, they're just saying, oh yeah, by the way, I don't have enough money to pay you guys, so we'll have to rearrange the deal and cut the dividend. So if you don't mind, it's gonna be this way now. So this is the preferred. Most of companies that have a rating of the dividend safety score of 2 at DSR will show this profile. In rare occasion, you will have good business with a dividend safety score of 2 if they haven't increased their dividend for the past at least 5, 6, 7 quarters. Sometimes we will wait up until 2 years to give them a dividend safety score of 2. A good example here could be Nvidia. Nvidia is a booming company, is an amazing company, but you know what? They apply Finance 101 when they have money in their bank account and they could create more value to shareholders by using it. They don't send it to them, to shareholders as dividend. They have increased their dividend for 2-3 years now from the top of my head. And when a company is focused on growth, you will sometimes see that, especially if they either have like several growth vectors to finance or they are making several acquisition as well. It doesn't mean it's a bad stock, but obviously it will not be on my top list either because they will get a dividend safety score of 2. It is really the way that I wanted to design my portfolio because my strategy is about dividend growers. Over time, dividend growers have been proven to outperform the market and do it with less volatility. So all the studies shows that you're going to make more money with less stress with dividend growers. And I kind of like that. I like that idea. I like this investing strategy. It keeps things very simple in my portfolio. I don't have to bang my head around the wall forever because I don't know if I should buy or sell. I focus on dividend growth. Now you will have a lot of companies that has a dividend safety score of 3. Dividend safety score of 3 is a decent dividend. You can expect a dividend growth roughly slightly enough to beat inflation, maybe a little bit more than that. So 3 to 5%. A good example could be REITs. A lot of REITs will show a relatively high yield, so 4, 5, 6%, but they will manage to increase their dividend for like 1, 2, 3%. There you go. You'll have a dividend safety score of 3. We also consider the future potential in this category, and we also consider the payout ratio, obviously. Now you go to good dividend. Well, this is a company that will have likely around at least 10 years of dividend increase. Dividend increase in high single digits, so 6, 7, 8%. They're on the roll. They show probably a good dividend triangle, and they will likely continue to reward you in that way. So everything that is between 5 and 10% of dividend increase year after year for about 5 to 10 years will get a good dividend safety score of 4. And now for the stellar dividend, the 5s, now you're talking about a company that has the potential to follow with several years of double-digit increase. Usually you'll find them with low-yielding stocks with high growth potential. Companies like Visa, for example, they're making tons of money. They have a very low yield, but very low payout ratio as well, and very strong dividend growth history. We're talking double digits for the past, I think, 10 years, right? So this is very rare, and it's good to have like dividend safety score of 3 and 4. That is not putting your portfolio at risk. The key here is to have pretty much all of them over 3, like 3 and above, I mean, and then you can have like 1 or 2 stocks with a dividend safety score of 2, especially if you're retired and you're looking a little bit more for income. I could understand that you're maybe a little bit more lenient and complacent with those. Personally, when I have one that has a dividend safety score of 2 in my portfolio, I'm looking to sell it very quickly. It's all about dividend growth, obviously, and the way that we calculate that is we focus a lot on the dividend triangle. So we're going to look at the trends. I've explained it in my DSR Pro rating video already, but I want to put a more emphasis on the dividend growth trend. Some companies that had a good run will had increased their dividend by like 8-7% for a while, and then you'll see that they revise their position. The next increase is like 2 or 3%, and the following one is again 2 and 3%. And then you realize, oh, this business has become a little bit more mature. The growth perspective is probably weaker now. It's still a good stock, but it will likely lose its dividend safety score of 4 and go back to 3 for that reason. Even though the history was great, you also have to look forward. To look forward, you look at the dividend trend, and you also look at how the payout ratio are being handled. And that is key, and you often need to dig into financial statement, just not look at financial website. They will give you an indication, but sometimes when there's a big big movement, like in the case for Silogist, there was a huge explanation, like a very clear explanation of why like both payout ratio and cash payout ratio went through the roof. And if you understand the explanation and you understand it was just a matter of it's a one-time shot, it was because they changed the compensation for management and they had to draw a lot of money to pay those managers and the CEO and all that. And for that reason, they had a bad year in terms of earnings and in terms of cash flow. But the following year, it was all settled, and now they were still able to increase their dividend. And this is what you can explain when you actually do the work, do the digging, and understand what's happening with the stock. Formulas, financial website will not tell you that, and this is why you need humans to make your rating mean something. On average, again, we cover over about 1,000 stocks at DSR Pro. And our batting average is pretty good. It's very rare that we're going to have a company that has a dividend safety score of 4 or 5 that shows a dividend cut. Even 3, very rare again. And when we have dividend cuts across the stock market, it is very often dividend safety score of 2 and 1s. So again, you work very hard for your money. You deserve better. Don't settle for weak dividend growers or no dividend growth at all. It just doesn't make sense. Look at each sector that you want to invest. Pick the 3-4 best stocks there with strong pro ratings, with strong dividend safety score, and then you'll be able to sleep well at night because you'll know that even if we go through a market crash and then your stock price goes down, those companies are very solid. They will survive the crisis and later on they will thrive. Most importantly, with a great dividend safety score, what's going to happen is you're going to get paid to wait, and even better, your dividend paycheck will still increase during times of crisis. That's all for today. I hope that you have enjoyed this video. I hope that you have understood a little bit better how I've created my dividend safety score. If it's unclear, send me an email, post a comment if you watch this on YouTube, and until my next video, stay invested.